about how, in that sense, for the governor has had to ticked all boxes. I know there were some very optimistic talk about front-loading a rate cut with a 35 basis point, etc. But the room has been left open for more, isn't it?
Yes, very much. The fact that they have changed their stance to accommodative essentially has implied that if it really becomes a difficult situation on the global environment, there will be a policy response, either in the form of comfortable liquidity or in the form of monetary policy action as and when required. So one thing is very clear: we are in for a very uncertain period, and policy responses, would probably face a massive push and pull factor also, especially for emerging markets, right? Because there will be shock to sentiment, there will be capital outflows, which will probably require higher risk premium for emerging markets, including India. And policymakers will also have to keep that in mind, while managing their domestic dynamics. But definitely at this point in time, the bias is pretty much towards a easier monetary policy, which also includes non-conventional easing tools, apart from just the conventional easing ones.
Okay, point well noted. Do we have Vishy? Then we should try and go across to Vishy very quickly. Vishy, you heard the whole policy as we have. You've read the statement as well. What has stood out?
What has stood out is this statement about global growth or global tariff conditions impeding domestic growth. That was something that stood out clearly, and this change in stance, of course, from neutral to accommodative, and the RBI governor clarifying to most people in the market that this is indicative that either the RBI or the MPC is going to go ahead and cut rates further or maintain status quo depending on whatever the situation is. What is also interesting is that GDP growth revision for FY26, or the expectations being revised for FY26, being brought down to 6.5%. At 6.7, RBI was still fairly optimistic compared to everybody else in the market. So the 6.7 to 6.5% reduction is something that you need to watch very closely, because the commentary is very clear that there is likely to be impact on domestic growth. However, he is sounding confident. The RBI governor is sounding confident as far as India's fundamental growth story goes. We are fundamentally strong. The current account deficit is likely to remain within manageable levels, and therefore impact as such is not going to be material, but there is some impact, and that's something that is sort of an acknowledgement from the RBI governor.
All right, Vishy. Thanks for that. So, well, global growth and the RBI weighing in on that, but with all of that put into perspective, still saying that probably India is slightly better placed. Katrina, come in on that as well. Does the confidence of the RBI, 20 basis points cut in growth, not dramatic at all, and the change in stance, as well as showing that the RBI is putting up its hand and saying that we will do what it takes, but it may not necessarily take a whole lot relative to what some of the other economies might need?
Yeah, I think that's certainly a fair point, because, I mean, if we look at India's exposure to global trade and specifically to US markets, if we're looking at economies across Asia, India is certainly right down the list in terms of its vulnerability. I mean, exports, for instance, they only account for about 10-11% of GDP, and then only about 17% of India's exports actually head to the US. So it's nowhere near the kind of figures that we see when we're looking at, say, Southeast Asia, which is so much more heavily weighted towards export exposure, and particularly to US and Chinese markets as well. So that's a positive. And so it does kind of go back to the view that policymakers in India don't need to do as much to try and effectively insulate their economies from the ructions overseas as what other economies do. So that's certainly a positive that policymakers can take away from this.
In terms of the inflation outlook, Madhavi, I want to come to you on this. The inflation outlook actually quite robust, but is that something which will be a bit of a wait and watch situation? If you listen closely to what Governor has said, he's curtailed the economic impact on GDP to 20 basis points, and inflation will come less, and emphasize the differential in tariffs. But we don't really know how all of this will play out, isn't it?
Correct. So, yeah, I agree. It may be too early to consider actual forecast changes to the extent of massive downgrades. But to state the obvious, there are clear risks to even a 6.5% growth forecast that the Reserve Bank has given at this point in time. This also will emanate from a much higher risk of a global recession if these tariffs are maintained globally. Now, at the same time, you would also see a massive disinflationary impulse for Indian industry, which could emanate from lower global commodity prices and also supply guts of goods. So I think while my co-panelists talked about Asia being much more hit than India, I agree that India is less exposed to the global markets versus emerging Asia. But India will unlikely to be a non-synced player in the EM Asia cyclical downturn that we will see. Historically, India has never, directionally outperformed emerging markets. They've also gone hand in hand with emerging market Asians specifically. At the same time, China's survival response to these massive tariff blows will really matter for India. Especially given that China is sitting with excess industrial capacity and there's a risk of dumping in the world, and specifically to its Asian trade partners. And we'll also have to watch out for FX as a counter tool, which would possibly be used by China because things are really getting very pushy for them. It will also have implications for India, Asia across. So there could be some inflationary pressure that could come from the depreciation of the rupee. But net-net, I think the disinflationary impulse would be much higher owing to what is happening in the world dynamics, both from commodities point of view and from the global growth point of view. I think even the 4% inflation that they're now targeting could also have a downside risk.
Okay, Anubhati Sahai, Head of South Asia Economics Research at Standard Chartered Bank, also joins in, as does Jayesh Mehta, Vice Chairman and CEO of DSP Finance. And thanks so much, both of you, for joining in the conversation as well. Jayesh, as per expectations, or did you expect some deviation from what the RBI has done in light of the fact that the US debt and the US paper is not quite behaving like how US paper would? It is as volatile as EM debt generally is.
No, that's very true, and that would happen till people, whoever wants to negotiates with US. I think till that time, there will be the way US paper would behave would be like any other emerging market. But at the same time, coming to our policy, I think it's really, I think people don't realize what he has said, and he also clarified. People were interpreting stance more with liquidity and all that. He's gone back to, the earlier days, pre-2013, where he made it very clear that what he means by accommodative, neutral, and tighter stance. So I think that's a very big difference. So that's, I think, going forward, I think it's just right now because of global volatility, but people, if this were global volatility situation was not there, this policy would have got very huge thumbs up situation. From the market.
From the market, yeah, because right now in the studio, we gave it a thumbs up. All the people that have come out have given it a thumbs up as well thus far. So, yeah, but the point well taken for the market. From the market, yeah. Point well taken. Anubhuti, do you give a thumbs up to the policy?
Absolutely. I think, this whole disassociation of the monetary policy stance between repo rate and liquidity was extremely, good move. In uncertain times, my key takeaway from this policy decision is that in uncertain times, you cannot expect the best of the outcome, and you will have to live somewhere in between. And that's what the governor did. He has clearly indicated that he wants more rate cuts going forward. And he knows that when rates are cut, it will be passed on to the consumers because you have this external benchmarking system. But potentially there can be episodes where it has not been transmitted to the money market if liquidity is not in ample surplus. But probably he has decided to live with partial transmission rather than having nothing in order to support growth. So extremely, a very, very wise policy decision in my view.
The question though is if this policy required a little more to be done, and I'm posing that question with a little bit of trepidation. I'm coming to you first, Anubhuti, on it. Simply because it's a fire going on, how many buckets of water do you need? and yes, this is what the doctor ordered maybe even 3 weeks ago, but right now, and I'm just coming off the reaction we're seeing both from bond and equity markets. Was more required? Could more have been done? Should more have been done?
Very interesting way to pose this question, and I would answer it that how many buckets of water do you need would depend on how fast and how big the fire turns out to be. We are still in that assessing mode. Was nothing delivered in order to manage increased uncertainty, especially after the April 2nd report? I think this whole switch in accommodative stance was to address the increased size of uncertainty and to ensure and comfort the market that there is more monetary easing, which the RBI is likely to provide, at least to the retail borrowers. So I think something has come forth. Could it have been a larger cut? Maybe yes, but it doesn't mean that it could have sent a wrong signal. It could have actually indicated a panic mode, which probably wouldn't have done too well for the market sentiment. So I think this policy was absolutely well balanced in terms of tone, stance, and the quantum of rate cuts. We will see more rate cuts going forward, but RBI has also retained its flexibility depending on how the current environment evolves.
I'm actually going to quickly take that question to Madhavi as well. While on the face of it, this is everything that the doctor ordered, stance has changed, rate has been cut, outlook has been determined very clearly that what the damage can be done is more required right now for the street to feel at least that there is some plan there.
Well, one doesn't know the extent to which this trade war could actually stretch, right? So, and I think in India, monetary policy may have to do the heavy lifting by being more countercyclical than fiscal this year. As we discussed, implication in India could not only stem from global financial market disruption, but also from real sector hit that we will face. We'll see how things pan out for emerging markets in general. I think while there is scope for negotiation, de-escalation, and market disruption could actually ease, but I think it would also be a pivotal turning point for emerging market assets, including that of India. As policymakers might also have to keep in mind that outflows in capital market could also require a much higher risk premium. And I think RBI may not want to use all its ammunitions too soon, right? Given the way markets behavior is at this point in time, given the way things are extremely fluid, and it didn't make really a great sense for them to front load rate cuts in April. But at the same time, going forward, if need be, as I was mentioning earlier, they could go ahead with more non-conventional easing in the form of further easier regulatory lending norms. They may even touch upon things like, lowering the daily CRR average maintenance requirement by banks to sub 90%. Another round of sterilized rupee management. All of that can still happen. So, I mean, they still have policy tools in hand, and they'll obviously play along when global uncertainty sort of eases or worsens.
I just quickly want to go across to my colleague Vishwanath Nair, who's been tracking, and he's joining us from the Reserve Bank of India. Just look at what's happening with gold financing stocks, Vishy. Muthoot, Manappuram not that badly hit, but Muthoot really taking it to the chin. Give us some details, if any are available, on what the RBI could probably do. What has the governor said? Because this is clearly a reaction to the governor saying that there will be more guidelines put out, but we're not clear what, right?
Right, Tamanna. So currently, there are separate guidelines that deal with how banks do gold loans and NBFCs do gold loans. So now, if you're going to merge them and come out with an integrated set of guidelines, typically that is code for tougher norms. Remember that the RBI has been talking about gold loans in regulated entities, which includes banks and NBFCs, and the current practices that are being employed by these lenders. And the RBI has had issue with the way that they have been doing this business, specifically dealing in cash, specifically not checking the quality of gold, also talking about hiring third-party assayers to come in and check the value of the gold. These are practices that the RBI wants lenders to avoid, and that's why a fresh set of guidelines are coming in. If you remember, last month we did report that the RBI had sought compliance reports from various lenders on the gold loan business. Specifically, the letters had to say how these banks and NBFCs have complied with the RBI's specific points that the RBI had raised on their business, and whether that compliance is in order with the RBI's existing guidelines. So now, if new guidelines are coming in, then there will be a fresh compliance exercise, and that will put some pressure on people who are dealing in gold loans. Gold loans, remember, because there has been an impact on unsecured loans because the RBI has been tightening that as well. Gold loans have actually grown very, very fast. So there has to be some amount of checks and balances there as well. So these new guidelines hopefully will place those checks and balances.
Vishy, thanks for that. And, that's the bucket that is moving post policy, because almost everything else is behaving the way as if the policy is given or has been exactly on expected lines. Now, Jayesh, what do the bond markets take home from this, in light of the fact that the world is an uncertain place, but the change of stance certainly would lead the markets to believe that, if anything, there is a pause ahead, definitely not any kind of a hike, despite what the Fed might say or do?
So if you look at swap market, right, the swap market was anyway pricing 2.5 rate cut before the whole US saga started, right, tariff thing started. I think yesterday evening and even right now, people are looking at including this 3 rate cuts, right? So that's there. But as far as the bond yield or bond per se is concerned, it is also tracking what's happened to the US bond, which has gone up in last 3 days from Monday to now, right? And that will remain under stress, or it will, as you said, we started with, it will behave like a volatile emerging market till the trade things at least start getting negotiated, or maybe, again, tonight there will be an expectation that it get deferred for another month or two for most of the countries. We don't know. So I think that kind of situation will remain. But, most of the international investors, particularly central banks, would be not really aggressively buying US bonds, and therefore impacting the US yields. And that will, from a trader's mindset, though it should not really matter. But right now, from a market mindset, they would look at that. So tonight, if the US yield comes off, we will see the bond yields coming off here too, very quickly.
Just a follow-up on what's happening with bond yields, and what do you think is the core concern? Because the kind of jump we've seen in the 10-year and the 30-year, Jayesh, that question for you is pointing to perhaps a bigger issue than even what we're seeing in US equity. And what will it take to stabilize this bit? What could we see in terms of movement from Washington to stabilize this bit?
I think it's a reset which is happening, right? So it's like it's not one country which has been targeted, and every country has been targeted, and there will be an expectation because a lot of U.S. deficit is funded by foreigners there, right? And anyway, if the trade is going to go down because all these guys were investing in U.S. treasuries only because they had trade surplus coming in from U.S. imports, whatever, with U.S., right? And that, if the trade surplus goes down, naturally their incremental appetite for U.S. bonds will also go down.
Right? Okay. So I just want to get a view from Katrina on what is happening with U.S. bonds and what we're seeing here, the kind of turmoil coming up if this movement persists.
I think what's interesting as well is to perhaps take a step back. And I mean, at the end of the day, we don't know how long these 9th of April tariffs are going to be implemented for, and whether they are just a negotiating tactic. And I think that uncertainty is contributing to the wild swings we've seen in financial markets, including in bond markets. And I think what has become clear is that, this trade war isn't just a US-China situation. This is a global, thing that Trump is targeting via really aggressive tariffs on economies right across Asia. And so what that means is that we're looking at a higher inflation picture for the US upwardly revised our view for CPI for this year and next year as a consequence of that. And so that higher inflation profile is feeding through to markets as well. And that is also contributing to a much darker path for the US economy. So our view is that, these 9th of April tariffs won't be implemented for a sustained period, but that is predicated on the assumption that they are somewhat of a negotiating tactic. But if they are not, and they are actually in place for a sustained period, then what our view for inflation for the US is going to be wildly different. And I think what we're seeing as well is that the Fed has a really difficult task in front of us, because, if they're looking at higher inflation, that does limit their ability to try and insulate the US economy from the turbulent and negative impact that these tariffs will have on many producers, but ultimately on the consumer as well, because consumers' purchasing power will be eroded under the fact that, non-discretionary goods will be a lot more expensive. And I think that that's the kind of uncertainty that we're dealing with, and that's what markets are trying to digest. But at the end of the day, we are really still at the whim of the announcements of Trump. So that uncertainty, I think, is going to be with us for quite some time yet, unfortunately.
Yep, most certainly. And pharma tariffs, major pharma tariffs coming soon was his statement this morning. So even if they are negotiating tactics for now, he's shying away from not deploying them. He's deploying them and saying, okay, come and negotiate with me. So fair point out there, Katrina. Now, Madhavi, in light of this and the fact that the tariffs have gone ahead as of 9:30 a.m. India time today, is the RBI's, are you at odds with the RBI's assessment of the growth number that they've given, or is this fair?
No, as I mentioned that, there are a lot of moving parts in terms of growth and inflation forecast, but I think the risk to RBI's 6.5% also looks to be on the downside at this point in time. This obviously will emanate from a much higher risk of global recession that will possibly happen as early as 6 months in case if these global tariffs are maintained. So I think to a large extent, India would not only face the uncertainty risk with regard to sentiment, but also with regard to actual hit to the real sector. So I think to a large extent, I believe 6.5 looks to be also an optimistic number. But on inflation, I think pretty much on the same page as the RBI, there are push and pull factors both on inflation. But on net, I believe that the disinflationary impulse will be the dominating one, which will basically emanate from much lower global commodity prices and possibly a supply cut of goods that China may dump to the rest of the world, and especially its trading partners in EM Asia. And as I said, historically, India has never been non-synced with emerging Asia in terms of cyclical downturns. So it's unlikely it will, outdo emerging Asia in terms of cyclical positioning.
Okay, Anubhati, would you agree with that? In that, because these are slightly unprecedented times and the tariffs rates are different, as well as how the economies are per se in terms of the quantum of exports to the US or otherwise are different, that India will be joined at the hip to emerging Asia, or could it be different if the tariffs stay for longer? I mean, final word with you, Anubhati.
Obviously, in the current environment, it is very difficult to be disjointed with rest of the world and emerging markets in general, because the theme which is driving every single country is what happens on tariff front, how long it sustains, will it cause a global recession or a US recession, will it lead to disinflationary pressure across emerging markets. So I think there will be a fair bit of association or co-movements between what happens to the emerging market at large and what happens to India. But India is definitely in a far better place because the extent of tariff imposed on India is lesser relative to, say, several ASEAN economies, and also because our exposure to US in terms of exports or goods exports is not as high as some of the other ASEAN economies. So yeah, relatively better place, but probably those advantages would play out over a slightly medium term. In the immediate term, I think India will continue to move in line with what's happening to the emerging market space at large.
And that pain seen in the markets today as well. Thank you to all of you for joining us on this conversation today as we break down the messaging coming in from the Reserve Bank of India, the policy completely fitting the bill in terms of what was expected by the street, a 25 basis point cut. Yes, that has come in. Stance changed from neutral to accommodative. That is something that was also expected as well. The markets, though, going through their own level of stress, and gold loan companies in focus. I think this is important, Niraj. Look at Muthoot Finance, now 9% down. Top loser on the street. Manappuram, interestingly, not that bad off. But the initial commentary coming in that Muthoot, as one of the largest players, has already adhered to a lot of the rules.
Yeah.
So if there are tighter norms coming in, will Muthoot be relatively better placed?
Maybe that, plus I think in Manappuram's case, the technical factor of the open offer price at 236 might be playing play as well, and which is why not as much of a downtick. But suffice to say, a good policy, Tamanna, both of us would concur on that, exactly in line with what was needed and anticipated. So no changes on that front, which is actually a good thing. Now time will tell how the markets react to this. As Jayesh Mehta said, though, that if this was a normal time, then it would have been a thumbs up from the bond markets.
Yeah, I mean, the umeed zyada hai is waqt, is how I can say. The expectations are higher. And not surprisingly, considering what is happening in the world around us, IT continuing to hurt. We'll take a very short break. We're coming back with Ask Profit, where your specific answers, your specific questions will be answered. Stay tuned for that and more.